Hi, and very welcome to SNS. My name is Louise Lorentzon, and I'm a research director here at SNS, and I have the pleasure to present today's seminar about inflation and the COVID-19 recovery. Today's seminar is a collaboration between SNS and the Institute for International Economic Studies, IIES, at Stockholm University. This collaboration creates a platform for insights from international economic research to be part of the Swedish policy debate. I would like to warmly welcome today's speakers, Luca Fornaro, Senior Researcher at the Center of Research in International Economics, Martin Flodén, Deputy Governor of the Riksbank, and Christina Nyman, Chief Economist at Handelsbanken. I would also warmly welcome John Hassler, Professor of Economics at the IIES, who will lead today's seminar. And before I hand it over to you, John, I would just remind you all that you're very welcome to take part in the discussion. For the audience in this room, simply raise your hand and wait for a microphone to ask your question. And for the audience online over there, please write your question in the chat and we will try to bring it up during the panel discussion. And if you want to tweet about this seminar, please use our hashtag SNSkunskap. Without further ado, I would like to welcome John Hassler up on stage.
Thank you. Thank you very much. So we are living in interesting times for sure now. Inflation is at record levels, at least for the time that many of us can remember. But we can still, I think, draw on experiences from the past, and we're going to discuss that today here. And I'm very glad to have Luca and the panel to discuss these quite interesting issues. Luca is an excellent researcher in exactly the things that we are going to talk about: inflation, recoveries, and international cooperation on these dimensions. Luca is from CREi, which it's nice because I think CREi is a sister organization of the Institute and perhaps even was a little bit of an inspiration for the creation of CREi. So it's great to have you here, Luca, and I'm not going to say anything more. I'm going to give the floor to you. Welcome.
Okay, so first of all, thanks a lot for the invitation. It's a pleasure to be here. So as John said, over the last couple of years, we've been seeing a massive rise in inflation rate around essentially the global economy. And that's what I would like to talk about today, but I would like to take an international economic perspective. So I would like to talk about some of the open economy aspect of this inflation rise. Particularly, first, I would like to spend a few words about the idea that we live in an era in which tradable goods, so commodities and manufactured goods, are scarce. Then I will link this to the international transmission of inflation across countries. Then I will turn to central banks' monetary tightenings and talk about international spillovers caused by these monetary policy actions. And then I would like to conclude with some ideas about potential gains from international monetary policy cooperation. Okay, so since the start of the pandemic, we've entered an era in which tradable goods are very scarce. And this is due to a combination of demand and supply factors. So on the demand side, consumer demand has been very unbalanced. So the pandemic itself pushed consumers to suppress demand for content-intensive services and turn toward physical goods, manufactured goods. Moreover, the fiscal stimulus, especially in the US, was mostly spent on durable goods. So this was another source of strong increase in demand for tradables. On the supply side, we've been seeing several factors making it harder to produce tradable goods, suppressing the supply. So on the one hand, we had a problem on global supply chains, which acted like a negative productivity shock for manufacturing firms. And then with Russia's invasion of Ukraine, we've been seeing scarcity of food, energy, and other commodities, which has pushed up their prices. And just to give you a picture illustrating this idea, here I'm plotting the price of manufactured goods compared to services in the US. Over time, typically, this relative price declines because there is faster technological progress in the goods sector. So what we've been seeing over the last 2 years is very unusual. We've been seeing a rise in the price of goods relative to services in the US, which signals the scarcity of tradable goods. Why is this interesting for inflation? Well, because in a period in which traded goods are scarce, the global component of inflation, so the component of inflation that depends on global economic forces, is likely to be particularly important. So for instance, in this diagram here, you see the decomposition of US inflation between 4 factors, so services, goods, energy, and food. And the message that I would like you to take away from this picture is really that in the US, the rise in inflation jump-started in the traded sector, so manufactured goods and commodities, and then later on spill over to the non-tradable sector, to services, perhaps as a result of second-round effects. If you look at the euro area, you see a similar picture. So in the euro area, of course, the rise in energy prices and food prices played a bigger role compared to the US, but also here, the start of the inflation rise really took place in the tradable sector. What are the implications? So, well, first of all, the fact that the global component of inflation is particularly salient means that domestic inflation is more than usually determined by global forces, such as global economic slack, right? Because in the end, the price of tradable goods are determined on global markets, not necessarily in country-level markets. So it makes sense, that now global developments will affect this component of inflation and we spill over across different countries. This means also that the international transmission of inflation across countries is likely to be particularly strong, so that developments in a given country will trigger changes in inflation in the rest of the world. So let me give you an example of what I have in mind. So since the start of the pandemic, there's been a sharp rise in consumption of manufactured goods by US households. You can see it here. So this is given by the blue line. Of course, at the start of the pandemic, consumption declined in the US, but then consumption of goods rebounded very quickly and actually peaked around the time when Trump and Biden check were sent out to households. So very strong consumption of goods by US consumers. How was this rise in consumption financed? So a good chunk of this increase in consumption was financed through imports from abroad. So this big rise in consumption was not due to an increase in domestic production of tradable goods by US firms, but really by stronger imports. How do you see that? By looking at the trade deficit, the red line. So during the pandemic, the trade balance in the US has deteriorated, meaning that US consumers started to import capital, to borrow from abroad, and to overconsume compared to domestic production. Now, what is the impact of these capital inflows and trade deficit on inflation in the US and in the rest of the world? So I would argue that capital inflows and trade deficit help to contain inflation in the United States. So they acted like a deflationary force in the United States. But this came at the cost of higher inflation in the rest of the world. So let me show you why I think this is true. I will use a simple diagram because I think it's useful to fix ideas. So here you have two countries, the United States and the euro area, which really represents the rest of the world. On the vertical axis, you have inflation, and on the horizontal axis, domestic production of traded goods. The upward slope curve is just a supply curve. It captures the idea that if firms charge higher prices, they will produce more because they will gain higher profits. The downward slope curve is a demand curve, which just captures the notion that if prices are higher, consumer will cut back on their consumption. Let's say that we start from this equilibrium, and suddenly, perhaps because of fiscal stimulus in the US, US consumers want to consume more. So there is an increase in demand from US households. So graphically, this is captured by an upward shift of the demand curve in the US. And if we were in a world of closed economies, what would happen is that the equilibrium would move up there. So there would be an increase in inflation rate in the US, some increase in production of tradable goods in the US, and nothing would happen in the rest of the world. There would be no inflationary spillovers. However, we live in a world in which economies are quite open, both in terms of trade and financial flows. And the adjustment in open economies will look a little bit different. It will look like this. So there will be somehow a rise in prices in the US, but this will be milder compared to the case of closed economies. What is the idea? So since US households won't consume traded goods, they can rely on production from the rest of the world to satisfy this consumption. So an increase in demand from the US gets spread over a large amount of firms in the global economy. So it makes sense that prices will rise by less. And at the same time, as you see from the graph, there will be a mismatch between domestic consumption and domestic production of traded goods in the US. So consumption will exceed domestic production, and the US will start to experience a trade deficit, so they will import capital. And this trade deficit, in a sense, helps to contain inflation in the US. It's good from the point of view of containing inflation in the US. What's the drawback? So you have to look at the euro area, the rest of the world, because high demand for goods by US consumers will push up prices charged by euro area firms. So this will correspond to a rise in inflation in the euro area. And this rise in inflation will induce euro area consumers to cut back on their consumption, so there will be a decline in demand. And this will generate a trade surplus. So in a sense, the euro area will start exporting goods toward the United States, but it will start importing inflation. You see, that's a very bad combination, no? Because now we have a rise in inflation in the euro area and a cutback on consumption. So it's hit on both margins. So these are the kind of effects that I have in mind. These are the kind of effects that might lead to a strong international transmission of inflation over our period. Okay, so of course, central bank reacted to this global rise in inflation by tightening monetary policy. So this graph here is showing you the number of countries tightening. And it's just to make the point that since 2022, we've been seeing really a synchronized tightening of monetary policy, both among advanced economies and among emerging ones. And now I would like to spend a few minutes thinking about the international spillovers triggered by monetary tightening. So when a central bank tightens, what happens to the rest of the world? Especially, how does inflation in the rest of the world react? And here I think that we need to really look at the exchange rate. Because when a central bank tightens, that country will tend to import capital, and so its exchange rate will appreciate. And I will argue that this will lower inflation. So the exchange rate channel of monetary policy is a force contributing to decrease inflation after a monetary tightening. What's the issue? Well, if a currency appreciates, it means that the other currency have to depreciate. So a monetary policy tightening will trigger a depreciation in the rest of the world, and it will end up exporting inflation toward the rest of the world. And just to fix ideas, let me just go back to the diagram that I showed you before. Again, we had the United States and the euro area. Let's say that we start from this equilibrium here, but that the Fed thinks that inflation in the US is too high. So it increases the policy rate, it tightens monetary policy in order to bring inflation down in the US. So in a closed economy, what would happen is that the US monetary tightening would pull back demand in the US. Low demand will induce firms in the US to cut back on prices. So we'll have the standard transmission channel of monetary policy. And in closed economy, of course, the monetary tightening by the US would have no impact at all on inflation in the euro area. But we live in a world of open economies. And in an open economy, I think there is an additional channel of monetary transmission. So when the Fed tightens, capital tend to flow toward the US because that's where the high return is. And this will tend to appreciate the dollar. And the appreciation of the dollar will tend to put downward pressure on prices in the US. So first of all, this additional channel makes monetary policy in a sense more effective because you get a bigger drop in inflation out of a monetary tightening. Moreover, the appreciation of the dollar will allow the US to run a trade deficit. So once again, US consumer will consume more than what US firms produce. So in this respect, the exchange rate channel of monetary policy looks particularly appealing because it allows a country to decrease inflation without decreasing consumption too much. So in a sense, the sacrifice ratio associated with the exchange rate channel is very low. Where is the issue? Well, once again, there will be an impact on the rest of the world because if the dollar appreciates, this means that the euro has to depreciate. And when the euro depreciates, prices in the euro area will increase. So the depreciation of the euro will put upward pressure on inflation in the euro area. And this increase in prices will lead euro area consumers to cut back on their consumption. So it will result in a trade surplus. The euro area will end up financing the US trade deficit by exporting capital toward the US. So you see that here, a monetary tightening originating from the US results in higher inflation in the euro area, and a particularly bad type of higher inflation, because this higher inflation comes with low consumption. And of course, the ECB will have an incentive to retaliate, to hike back in order to reduce this higher inflation. And this kind of mechanism might lead into a situation in which countries might want to run into competitive appreciation, in which each central bank may want to hike the interest rate in an attempt to reduce inflation, in part by appreciating the exchange rate. But of course, if all the central banks in the world try to appreciate the exchange rate contemporaneously, we will enter a bit of a rat race, because they will all try to appreciate, but in equilibrium, the impact of this action on exchange rate will wash out. And all that we will be left with will be an excessive monetary tightening, an excessive global economic slump. In a sense, because individual countries perceive that disinflating is not too painful because they can rely on the exchange rate. But when the disinflation happens contemporaneously in many countries at the same time, this exchange rate challenge is not operative, and so disinflation is more costly than what individual countries perceive. Now, let me say that this might not be necessarily the scenario that we will face. We might have a soft landing in the year to come, so we might reduce inflation without facing an economic slump. But the fact that we might need to suppress economic activity and enter a global recession in order to bring down inflation is a possibility. And in this case, this kind of concern can become important. So, essentially, this idea of competitive appreciation suggests that national central banks may fall into a coordination failure. So collectively, they will not want to tighten too much, but in absence of cooperation, in absence of coordination among national central banks, we might end up in a case in which the monetary policy tightening goes too far, in which we have an excessive global slump. Well, what's the solution out of it? In theory, the solution is international monetary policy cooperation. So central banks should sit down and talk and agree on coordinated action. In practice, it's not clear that this is attainable. It's not clear that cooperation is easy to attain. And just to conclude, let me mention two more things. So the first one is that this idea of competitive appreciation contrasts a bit with the usual notion of competitive depreciation. The idea that countries want to depreciate the exchange rate to export more. But this idea of competitive depreciation is typically salient during period of weak global demand. Think about the Great Depression or the aftermath of the Great Recession. And now we are living in an era instead in which tradable goods are scarce, which supply is too scarce compared to demand. So it makes sense now that the coordination problem gets reversed and now translates into a willingness to run for competitive appreciation. The other point that I wanted to make is that some of these considerations may look very theoretical, but actually, if you go back to the 80s, to the Volcker disinflation, to the 80s disinflation, they were very present in the debate. So back then, there was a sharp appreciation of the dollar. The US was running very large trade deficit, and other countries complained about that because they felt that the combination of strong dollar and US trade deficit was exporting inflation to them. Back then, this kind of considerations were important. And they eventually led to the Plaza Accord, which was an agreement for coordinated monetary intervention among major central banks in order to bring the value of the dollar down. So again, just to conclude, I'm not sure whether these kind of factors will play a role in the months to come. It might be that we will face a soft landing, and so there will be no need to engineer a global economic slump to control inflation. But if things don't go that way, so we will need a global recession in order to control inflation, then this kind of idea suggests that there is scope for international monetary policy cooperation to ensure that we don't go too far with the monetary tightening. We don't go to an excessive global recession. I will conclude here.
You can stand here. So just one question comes to mind. So it sounded a little bit like the root of all evil is the US, the fiscal expansion and the Federal Reserve hike of the interest rates after it. And maybe it's not the root of all evil, but how large do you think that the problems that we have now are due to US policy?
Well, I will not put it in terms of evil because, in a sense, the US are doing what's best for them. The problem is that what's best from a US perspective might not be aligned to what is best from the rest of the world. And in terms of the quantitative importance of these forces, by how much quantitatively, for instance, the appreciation of the dollar that we saw in the first half of 2022 contributed to high inflation in the rest of the world, it's hard to say. But if you go back to the debate of last summer, for instance, if you look at what some board members of the ECB were saying, when they observed the euro depreciated by 20%, they started feeling that they might put upward pressure on euro area prices. That was one of the reasons mentioned for the initial large hikes in interest rate in the ECB. So quantifying this effect is difficult, but it looks like they're present in the mind of some policymakers, at least.
But you think that one can make sense of the US policies because you said that they do what's best for them, and that includes the fiscal stimulus, you think, because that clearly has had negative impacts on us.
Yeah, that may be. So, well, rather than thinking about whether fiscal stimulus in the US has been excessive or not, what I think it's interesting, concerned to what we were talking about before, is that the fact that we live in a globalized economy and the fact that the US were allowed to run a trade deficit, so to finance consumption through imports, I think for sure reduced the inflationary impact of the stimulus in the US, made it more appealing for the US, but at the cost of higher inflation in the rest of the world.
Okay, thank you. I'm going to bring up the panelists also. Christina and Martin, you were already introduced, and I don't think you need any introduction here. So I'm going to ask Martin to start with some comments, please.
Okay, thank you very much for having me here, and thanks to Luca for this presentation. And it is a topic that I think is highly relevant for us here in Sweden. And actually, I have been discussing this a little bit with Luca previously already last year. And it reflects, his analysis reflects a lot of my thinking. So for sure, there are policymakers that are thinking along these lines. And I think the analysis that you present is more relevant for us here in Sweden than for the big countries, because we, as a small open economy, what happens to the exchange rate, it will have a much more important impact here than say in the US, that even though they have large trade deficits, etc., they are not so dependent on the exchange rate. So that is the starting point. There is and has been a lot of discussion about the exchange rate here in Sweden. The Swedish krona is very weak, and it has been so for some time. But it has depreciated quite a lot during the period when all central banks have raised their policy rates. And I think this reflects quite a lot of the type of analysis that you presented. So we could summarize it a little bit like this. We were all hit by roughly the same inflationary or cost shock. And it was a global shock. To some extent, it was generated by US fiscal policy, but definitely not. So let's ignore that part. Say we were hit by the same policy shock. And we did similar things with the policy rate, but that doesn't reflect all the reactions of economic policy, or the policy rate in itself doesn't reflect all of the necessary contraction that we would want to see in a particular country. So one thing here is that there could be this rat race that all countries, they don't want to see the currency depreciate, but rather to appreciate in this situation. I think that is relevant, but I think even more relevant for us here is the interest rate sensitivity of the Swedish economy. So we are different in that we have households that have very high debt relative to households in other countries. We have households and corporations, businesses that basically borrow with variable interest rates, floating interest rates. So there is a large impact, immediate and large, because of variable rates and large debt on household cash flows. So you could argue that a similar hike in policy rates has a much larger impact on the Swedish economy than in other countries. That's one part of it. So maybe if we were an isolated country and didn't have an exchange rate, etc., we would hike the policy rate a bit less than other countries. Then in addition to this, we have fiscal policy in Sweden that by many is assessed to be roughly neutral, in contrast to basically all other countries where fiscal policy is rather contractionary, depending a little bit on how you measure it. But look at the IMF's, for example, measure of structural government balances is very negative in most countries except for Sweden. The fiscal policy is more expansionary in other places. We have wage formation that is very well behaved in Sweden. So nominal wages are not increasing very much. They're increasing much more in some other countries. So household real disposable income is falling more here than in other countries if we ignore other parts of economic policy. So all this speaks for that it would be easier in some sense to control inflation here. We don't have to do so much, or we have a very good institutional setup that results in good economic policy. But the flip side of all of this is that we then are hiking the policy rate a bit less than other countries, and the market is anticipating this. So instead we get the krona that is depreciating. Could have a discussion about how important this mechanism is, and I think John maybe has some views on this, and I would be happy if this is not particularly important. But the end result then is that we have a krona that depreciates, so we get a lot of imported inflation in combination with a slowdown in the economy that is stronger than in other countries. So the lesson, I think, is that it's very problematic to be different in this respect relative to other countries. It's not a good idea to be more interest rate sensitive. It is another argument for why we need some kind of structural reforms so that we don't have households with much higher debt than in other countries, and that all households don't have variable interest rates. And I think the lesson for other countries is, or it would be helpful for us if they had a wage negotiation process more similar to ours, and fiscal policy that was in better shape than what we are currently seeing. Otherwise, as it turns out in this particular situation, it is more challenging for the Swedish economy than for many other economies, I think.
Thank you. Let me just quickly follow up since you took it up. No, so I'm actually referring to your own research, so done at least in association with the Riksbank, that suggests that the relation between policy rates and exchange rate is very, very shaky and pretty weak. So do you think that this time is different, or what do you think?
Well, the two parts of this. First question is, how does the policy rate, monetary policy, affect the exchange rate? The other part is, how does the exchange rate affect inflation? So the first part, I don't know, and I've been going back and forth in what I believe, and I think the Riksbank has also. So sometimes we've said, well, what we do, it's not the main explanation for why the krona is depreciating, and sometimes we say that it is. It is a difficult question. I don't know what the answer is. Clearly, there is an element of monetary policy behind what we have seen in exchange rates in Sweden and Norway over the last a year and a half. The Swedish and in particular the Norwegian krona have been depreciating because the markets have anticipated smaller rate hikes here than in other countries. Theoretically, it's a little bit difficult to understand the magnitudes, I think, in the depreciation. But understanding exchange rates, it's really tricky. The other part is, what is the path through to inflation from the exchange rate? Our traditional rule of thumb says that there is a path through in the order of magnitude of 1 to 10 or maybe 1 to 20. So we get a 10% depreciation that could lead to 1 percentage point or maybe just a half percentage point higher inflation. I think this time is different, definitely, because now we are importing inflation, cost shocks, and suddenly all firms started to change the prices. It was unavoidable. Normally, they would see through a lot of this and just let price fluctuations over time even out. But now they had to raise prices. The National Institute of Economic Research, they said that roughly they raised 1-to-1 with the cost increases. And why would they treat the exchange rate differently from the international prices of commodities, etc.? So I suspect that the pass-through has been unusually large recently.
And very much so. So
Yes.
an order of magnitude larger.
Yes.
Christina?
Yeah, thank you. This is really a hot and important topic, and thanks for the presentation, Luca. And I visited US in October last year and met a lot of think tanks and policymakers, and I don't know how many times I heard that our dollar, your problem. So, and I do actually, according to Fed, of course, and I do actually think that I agree that you have to focus on your national target and your mandate and so on, but it's not an easy thing, and it's definitely these side effects, negative side effects. And so there are two things I would like to lift here, discuss, and both are connected to credibility for central banks. And because I do think that there is a problem with this, what do you say, rat race, and it's not nothing that we want to have. But I do think there are credibility issues here with coordination, and it would be nice to discuss more this coordination if it's possible. I think it could be a risk that if you try to coordinate monetary policy between countries, that you actually decreases confidence for central banks. It's so important with your independence, and if you start to discuss with others, it could be some credibility issues here with the independence. And of course, as you said, there are all these practical issues here. Should you have like vote between countries, and what should you do? So of course, it's I understand it's kind of a theoretical thing, but you also say in the end in your article that I read that there could be an issue for national governments to take this into account some way. So how can we do that in them if this is, as I think, important? So that would be nice to discuss. The other thing with credibility is according to or connected to the inflation target. That if we take Fed for an example, if they would focus on more the global effects of their policy and not do whatever they can to fight inflation in US, they risk the credibility for the inflation target, and you could lose the anchor for inflation expectation and so on. And in the end, I think that would actually be negative for other central banks and other countries as well, because if US lose confidence in the inflation target, probably other countries will do that as well. So I think that's a very important question. And then of course, if you would like to be more practical and so in real time, it's really difficult to really know if it's a supply shock only or if it's a supply demand shock. I think in the beginning of this cost push crisis, we actually saw it, those central banks saw it all over the world and economies as well as mostly a supply shock, negative supply shock, and that you should look through this with monetary policy and wait it through. So, but instead we got a demand shock as well, connected to the supply shock, and the reallocation between services, demand for services and goods. Actually, when we open up the economies, we did see less of a demand for tradables, at least a bit, at least in Sweden, but also a bit in other countries. And that was expected. Maybe we did expect an increase in demand for services, but I don't think anyone expected that the demand would be so high and that we would have a shortage of labor also in this service sector, hotels, restaurants, etc., and that we actually got this big difference between demand and supply, both on goods and on services. So, and this is also easy to say in retrospective that you should do this or that, but looking now, we can see that it's probably monetary and fiscal policy was too expansionary too long. But we thought it was, many of us thought it was transitory from the beginning. But that's not. And just on the currency then and the rate rise, so I absolutely do not think that central banks should try to fight the currency in a kind of a what you say, currency war or something like that. I think that's very, very bad and probably will not succeed there. But on the other hand, you actually have to take the currency channel into exchange rate currency into account, of course, when you do your inflation targeting and set up the monetary policy in different countries. So yeah, it would be very good if we could coordinate. I think that would be better for the world, but is there a way to do that with all these negative side effects and the risk of credibility? So thank you.
Luca, can we do that? Can we coordinate?
I would like to build up on your point about credibility, because I think it's important to understand also the exchange rate pass-through, because I think that, even if the direct effect of pass-through to import prices is not huge, there is a risk that second round effects might build up. So especially, if wages start increases in response to inflation, if firms start trying to seek for higher markup in response to an inflation rise. And here I think it's where credibility becomes crucial, no? Because the pass-through from exchange rate to inflation might be small if the central bank is credible. So if agents know that a wage price spiral will not kick in, but it might become large if somehow credibility is lost and workers and firms start thinking that an inflationary mindset will build up in the economy, and this might generate a wage inflation spiral. And this, I think it's one of the reasons why central banks, even if they might not explicitly say so, are keen to react to the exchange rate, because it's one way to build credibility. If the central bank react to a movement in the exchange rate by tightening, then this reduces the risk, the second round effects become big, and this reduces the pass-through that we observe in equilibrium. And the other point that I wanted to mention is about credibility and independence, which goes back to what Martin was said. So perhaps in the economy that we live in, which is so globalized, where we have a lot of free movement of capital, a lot of free movements of goods, perhaps central bank independence is greatly reduced, not independence from fiscal authorities, but independence from what other central banks are doing. So perhaps right now, compared to what it was the case perhaps 30 years ago, there is less margin for maneuver for national central banks, because if other central banks are hiking, there is little choice but to hike too, even if that might not be optimal given the domestic economic context.
So Martin, I know that you are meeting with central bankers from other parts of the world, also in closed rooms. If there is a large gain of cooperation, couldn't you do it?
No, I think what Christina said is mostly right. So it has been mostly.
Not right.
No, well, I'll come to that. So it has been a topic, actually, with discussions very similar to what we are talking about now. And the one typical thing that we hear is that, well, of course, all central banks, they have a domestic mandate. So no central bank has a mandate to help another country. But the point actually that Luca is making is that it would be good for everyone potentially to cooperate. So in principle, it would fall under the mandate, which is sometimes, I think, missed in those kinds of discussions. So everyone starts from like our currency, your problem. You can think about which currency in particular. So in principle, I agree, it could be beneficial with cooperation. I'm not sure that the quantitative importance would be very large. If it was, I think there is some scope for cooperation. And in particular, another thing that is often forgotten, and that's why I said maybe or mostly, is that there is a little bit of cooperation already through the International Monetary Fund. So they have a mandate to make sure that the currencies are not manipulated. I don't know exactly how the mandate is formulated, and countries have subscribed to this. We should not work excessively with the exchange rate. In particular, we are thinking about competitive devaluations, and that is like an understood policy coordination among central banks, that we cannot use a policy that only works through the exchange rate. So in that sense, we are already cooperating.
My view as the IMF view there is that you are allowed to use the currency policy if it is for the monetary policy, for the inflation target.
Yeah,
I mean, that's what was the Riksbank said, having this mandate for
yeah,
the.
well, so the IMF, I haven't followed this sufficiently closely. So Sweden typically falls under the radar here, but Switzerland has been the typical country that has been discussed, and the IMF, I think, coined the term quantitative external expansion to somehow make sure that what Switzerland was doing was viewed to be okay. And but still, it was part of that analysis. Is it okay or not to do what the particular country is doing? How much do we have to take into consideration the spillover effects, etc.? So it's not totally off all possibilities, but I think it's very unlikely to work in practice, and I think it's unlikely to happen in practice.
So in the end, it is a quantitative issue, right? Is the value of cooperation big or not? And would the equilibrium be very different with cooperation? And I interpret you, Martin, saying not so big. We are not very far away from a decent cooperative solution. Do you want to challenge that? Or?
Well, to me, it's very hard to quantify these kind of effects. But what I think is that there might be very state dependent. So, the gain from coordinated might be very small if we manage sort of a soft landing. But if that's not the case, if we enter a world like the 80s in which a big global recession is occurring, they might be larger. So that's my idea. And let me also say that I'm not very optimistic about the possibility of international monetary policy cooperation, because if I look at the 80s, it is true that there was the Plaza Accord and there was a coordinated intervention, but this came in 85, which was after the disinflation in the US had mostly take place. So it's not so clear that that was an episode of coordinated intervention to reduce inflation, or whether this was driven by other motives.
I think we had a question here from the audience. Was it someone? No, was it?
We have a digital question from the digital
Let's
audience.
hear it.
So this is from Jonas Nykander from Stockholm University. Wasn't there large fiscal and monetary stimulus in many countries during the pandemic, not just in the US?
Luca?
Yeah, I would say that was true, but in the US that was particularly strong, I would say.
And I think also the stimulus in the US, so everyone tried to mitigate the effects of the pandemic in a situation when a lot couldn't really happen. But what was extreme in the US was what happened in 2021, I think, when fiscal policy was made even more expansionary with a lot of cash payments to households. So that is where the US was an outlier, an extreme outlier, I would argue.
Well, yes, exactly. And if you look at disposable income in US, it's actually much higher during the pandemic than it would have been if we did not have the pandemic, even though unemployment skyrocketed. So, but we had a lot of fiscal stimulus in Europe and Sweden as well, but it was more to companies keeping staff than directly to household. But okay, it's the social welfare system is very different as well, of course.
Any other question? I'm not, even though I know many of you, you are obliged actually to say your name and where you come from.
I'm on Hustler. My name is Claes Eklund. I work for a law firm actually. So I want to, if Martin mentioned the mandates of central banks, and let me put this question a little bit more bluntly. If you really want the big banks like the Fed to sort of engage in systematic cooperation and coordination with other central banks, wouldn't that necessitate a change of legislation in the US that actually gives the Fed such a mandate, because they don't have that mandate today? The law states specifically that the Fed has to deal with American inflation and employment and so on and so forth. So what we're talking about is not only big sort of policy changes, we're talking about big legislative changes as well.
It's not only America first, it's America only.
Well, here, let me answer in two parts. First, the idea is that, cooperation might be beneficial for every country in the world. So cooperating with other central banks may help national central bank to attain their domestic mandate. So here is not the idea that the US or whatever other country should care about what happens in the rest of the world in itself, but he should care about it because there are second round effects, spillovers back to the domestic economy, and cooperating is a way to reduce these effects. And if I can mention, let me now strike a more positive note in favor of cooperation, because there is one dimension of international monetary cooperation, which I think is very important, which are swap lines. So we see routinely the Fed and other central bank lending dollars and euros to other central bank in difficulties. This is a form of cooperation which works very well. So we might attain perhaps cooperation on other form of monetary policy as well.
Another form of cooperation that we're seeing, and that has changed, it's of course the ECB and the euro. So you can consider what would Europe look like today if we had 20 different currencies and central banks. And some, obviously, some parts of the cooperation have improved, but also then we have all the discussions about optimal currency areas. And if countries are different in terms of, also within the euro area, of course, countries are different in how they are affected by monetary policy, interest rate sensitivity, and their different fiscal policies, etc. So the cooperation, of course, implies that they all have the same interest rate. But yeah, no currency competition within Europe, but the other dimensions of having the same, of course, not optimal currency area you have.
Yeah, and I'm still thinking about this. If Fed take other countries into account and don't raise interest rates according to their inflation target, what will happen to inflation expectation and the credibility in the US? You talked about what happened with other countries, but I'm not sure if you are expecting spillover effect to be negative to US, but as they are like a big domestic market, and maybe these effects will be very small. So and that's my fear, that there will be actually inflation expectation they will lose their anchor in US, and if they do that, other countries will do it as well. So but yeah, so that's my question. And the other thing is, well, how would the monetary policy look like if we had coordinated? So two questions.
So yeah, on your point, I think it's right. I think the credibility is crucial, not least because, as I said before, credibility is crucial to contain the pass-through from foreign monetary policy tightening to domestic inflation. On the other hand, it's not clear that coordination would necessarily hurt the credibility. So say that all the central bank in major economies agree to some coordinated action. Would that make the disinflation more or less credible? It's not obvious. It might very well be that some coordinated statement, some coordinated action might make it more clear that we are going to bring inflation down. So I think the coordination is very interesting, but it's not so clear-cut that coordination will hurt credibility, may even enhance it.
Because coordination here will mean that you will not hike interest rate as much as you do if you do not coordinate.
Yeah, but right. It's a common agreement. So the central bank agrees to do so that we understand that we're not going to have funky stuff on the exchange rate front. So that's the idea.
A question from the right flank here.
Thank you. Anna Pettersson Westerberg, State Secretary. I just wanted to ask something about the fiscal policy in this context. Does it have a role to play? And what would it be? Both US and Sweden, I mean, of course, not increased demand, but is there something on the supply side, or is it just first line defense that is important here?
It sounds like, the coordination value of fiscal policy is very large too, right?
Yeah.
Not the least within the euro area. So anyone?
If we can take that, I think, yeah, perhaps coordination in fiscal policy is even more crucial, and perhaps it's even harder to attain. Because, for instance, think about the example that I gave before, the big fiscal stimulus in the US driving up prices elsewhere. Another important dimension is, imagine that the government puts up some transfer to sustain demand for energy for poor families which are hit by the energy shock. This is going to push up energy prices in other countries as well. So that's another form of negative spillover. So it looks obvious that there are gains from coordinating fiscal policy as well. I'm not that confident that we will reach necessarily big agreements on that front.
Please, if you get the microphone, because we are broadcasting. So
maybe a leading question, but is it important to try to increase the supply side by fiscal stimulus, fiscal policy here to do something about the inflation? Or is it just not in this context?
So I see that mostly as a separate question. It's always good to boost the supply side, and good structural reforms should always be done. But it's relatively unlikely that they will be important in the near term. I think those things often take a long time both to implement and then to have effect. So it's unlikely, I think, that will be the solution to the high inflation that we are seeing now, or even that. Of course, it will work in the right direction. So we should definitely do it, but we will still have to do our job from the Riksbank side, I think.
And it is true that there are benefits from supply side policies in other countries that spill over, right? So,
yes.
So there is a coordination issue.
Yeah. And there was, the idea at the start of the pandemic, especially in Europe, with the Next Generation Fund, to coordinate some increase in investment, both public and private finance, with some global funds. So that was an attempt at coordinated, which probably was a bit frustrated by Russia's invasion of Ukraine, but we do see some attempts at coordinating fiscal policy on the supply side. Yeah.
From the back.
Thanks. Magnus Lindskog, currently representing the Riksbank, but actually changing jobs to Handelsbanken. So, no, you showed inflation dynamics being more driven by tradable goods and then more and more services. So that shift, say that inflation is more and more driven by service sectors. Does that change the need for coordination of monetary policy? Does it make it more domestic?
Yeah, that's a good question, which I will need to think about it more. It might be the case, yeah, because this suggesting that, especially in the US, the local component of inflation, the service component, has become more important. In other countries, this is not so clear-cut. Like in the euro area, it's true that the service component of inflation has gone up, but still the tradable part is very important, especially the energy and the food component of the inflation rate. So perhaps in a world in which all the high inflation is driven by services, cooperation might be less important. It's not necessarily the case, though. It depends on, as we were saying before, on the pass-through from the exchange rate to local wages, because you can still think that an exchange rate depreciation might make the inflation problem worse if this triggers an increase in wages, which will spill over into higher inflation in the service sector.
Just have I just come up with this now, but is one solution to have another inflation target, to have a more like a domestic inflation target, for example, or a target for wages or something, so you don't include the imported? Would that mean that you get another monetary policy that actually will not have this negative side effect that you talked about with the supply chain?
That's a difficult question, but my impression, Martin knows much better. This is the central bank, monitor wages very quickly, very carefully, and wages is a very big input in monetary policy decisions. So,
I mean, there are a lot of research saying that you should have domestic.
And in particular, I think from CREi, or Jordi Gali is really pushing, I think, for having the inflation targets to be only the inflation measure should be some very domestic measure. I think in practice, it's not really, it's difficult to measure what is domestic. And also we want the targets to be something that people care about. And they don't only care about what is domestically generated, etc. So it would be problematic for both for communication and for the relevance, I think, of the inflation target. And in the extension of that is that credibility could suffer from an inflation target that people don't think is sufficiently important. In principle or in theory, yes, there are arguments for doing that, but I think there are also some practical arguments, important practical arguments against.
Jag heter Per-Arne Rudbert och jag är egenföretagare. I have a question about the P&L focus on inflation and no focus on balance sheet. In other words, low interest rates gets an inflationary pressure on assets. Is that something that you have started to consider, or is that out of the picture?
Well, so this is a very old discussion. What should be the target for monetary policy? Should it be inflation, consumer prices, or should it be like the value of money, which is more like including different asset values, etc. And again, this comes, well, I think actually maybe John, you were involved in a public investigation about this like 25 years ago, weren't you?
Was I?
Had a
I don't remember that long.
I think. Didn't you participate in that?
Oh, maybe.
Or you're
I did actually. But
yeah, Christina did. So
that was a very long time.
it's I think all central banks have ended up with saying that it's consumer prices that should be the target. It would be more political. There are many arguments in this discussion, and most arguments against the kind of asset price measures. It becomes very political with allocations of etc. That's one part of it, and do we want to have a central bank that tries to target house prices, for example?
So Martin, at least it sounds like, these kind of issues that we're talking about here are salient in what your discussions at the central bank and also in your international discussions. So I'm coming back to this thing about, the possibility of coordination. It sounds like it's much easier anyway when it comes to monetary policy than when fiscal policy, because in the fiscal policy discussion, considerations like this are not really far away from salient. Is that true?
I don't know that much about the fiscal discussions, but there are some attempts to coordinate fiscal policy within Europe, for example. It doesn't work, but
and perhaps because of this, that it's so many other very strong forces that are kind of not possible to separate out.
That's right.
Luca?
I'm also not an expert on international fiscal policy coordination. My hunch is that it might be easier to achieve a coordination among central banks than national fiscal authorities. But as we were saying before, there's been an attempt of coordinating fiscal policy too, especially in the European Union.
Yeah.
And that might be a fruitful path to pursue in the future.
But it's also, of course, very controversial, not least here, because there is a feeling that it's used for other purposes to strengthen the center of the union and things like that.
Yeah, it's very political, very controversial. It's very tough to achieve coordination in fiscal policy, but perhaps especially inside the euro area might be a good idea.
We have time for a final question. I think there was someone hand up.
It's a digital.
Or is it you, Louise?
Yes, we have a digital question again. So what is the relative importance of the pandemic and the war in Ukraine for the present inflation?
Martin, you must have an answer.
Well, I think inflation started increasing in 2021 a lot in the US, to some extent in the UK, and clearly that was not because of the war in Ukraine. It was more related to supply disruptions and increased demand after so a mismatch between supply and demand after the pandemic. The pandemic is clearly very important. Then in Sweden and in most of Europe, we thought that this would not spill over really to our economies. The war in Ukraine changed that a lot. So I would argue that a lot of the inflation we're seeing today is because of the war. But we also saw basically at the same time as the war started, maybe even after, but with data lags, etc., we didn't see it until after the war has started, that inflation started to increase in January 2022 a lot more than we thought. So clearly it's not only the war in Europe either.
Okay, I have a sheet here that Louise gave me, 11:29, concluding remarks by Louise Lorentzon, and it is actually exactly 11:29.
Very good. Thank you so much, John. I would just like to thank our speakers, Luca Fornaro, Christina Nyman, Martin Flodén, and our excellent host, John Hassler, for this, and the audience for an interesting discussion. And I hope to see you back here soon again. Thank you.